And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our, in our policy.
Hey everyone, welcome back. This week, US markets hit fresh record highs, tech is on fire, and investors are feeling that classic FOMO. From Fed rate cuts to AI-driven optimism, there's a lot to unpack. And we're breaking down exactly what's moving stocks, where investors are rotating their money, and what you need to watch for next week. Quick disclaimer, guys. This video is just for information and education only. I'm not giving financial advice here. Make sure you always do your own research before making any investment moves. Markets hit fresh record highs this week as FOMO drove investors into everything from tech giants to small caps. The rally has been fueled by Fed rate cuts, strong inflows, and a wave of AI-driven optimism. Some are even calling it dotcom on steroids. The S&P 500, Nasdaq, and Dow Jones Industrial Average each posted gains of over 1% for the week, while the Russell 2000 surged 2.2%, reflecting strong performance in small-cap stocks. Tech led the charge again, with Intel spiking on news of a $5 billion Nvidia stake and partnership, lifting semiconductors and the Nasdaq to record highs. On the trade front, the US and China held a constructive call, though no concrete deals were announced. This week, markets had plenty to digest, from the Fed meeting to fresh economic data. At the FOMC meeting, the Fed delivered a 25 basis point cut. Chairman Powell called it a risk management cut, emphasizing that future moves will be decided meeting by meeting. His tone was cautious, patient, not the start of a full easing cycle. On the data side, retail sales surprised to the upside, showing the consumer remains strong. WASS. Jobless claims dropped back toward normal levels after last week's spike, and Powell noted that some labor weakness stems from immigration policy shifts, not corporate layoffs. Some analysts are warning that markets are becoming stretched, particularly in growth and tech sectors. Global equity valuations are high, and investors pulled nearly $39 billion out of global equity funds, the largest weekly outflow since 2020. US equity funds alone saw $43 billion in withdrawals, while Asian and European funds saw inflows. Investors are rotating, trimming exposure to pricey US equities, while seeking safety in bonds, gold, and select emerging markets. The S&P's RSI signals overbought conditions. Historically, September tends to be weak, and higher long-term yields or sticky inflation could spark a pullback. Looking ahead to next week, several key economic reports could influence market sentiment. Tuesday, existing home sales data, shedding light on housing market health. Wednesday, new home sales and durable goods orders, offering insight into consumer spending and manufacturing activity. Thursday, second estimate of Q2 GDP, providing a revised view of economic growth. Friday, personal income and spending data, along with the University of Michigan's final consumer sentiment index for September. Investors should stay alert. Strong markets, yes, but the signals suggest caution as we head into next week. That's a wrap for this week. Here are a few setups looking good for a long trade. Have an amazing weekend, and I'll catch you in the next market update.